Welcome back to the Deep Dive. Today, we are wrestling with a classic financial paradox, one that sits right at the nexus of future energy promise and current financial failure.
Yeah, we're talking about Plug Power, ticker PLU, Joe.
A company that operates in a market projected to be worth almost $400 billion, yet it's priced like it's facing bankruptcy tomorrow.
That's the high-stakes narrative we have to unpack, and we are anchoring this discussion firmly to the data available as of November 18th, 2025.
Right, with the stock trading near $2.09.
And the tension here is almost unbearable for investors because the market is sending two massive opposing signals. You have this massive potential on one hand.
And just fundamental failure on the other.
Exactly.
I mean, think about the scale.
Yeah.
Plug Power is a 25-year pioneer in the green hydrogen space.
Right. And this is a market that Global Consultants Project will grow at a stunning 45.9% annually.
45%, that's huge. Reaching $388 billion by 2035.
It's the definition of a secular growth trend, and the bull case, really, it rests entirely on that premise.
And yet, despite being the established name in that trend, the company is, well, it's scraping the bottom.
We've seen analysts just aggressively downgrading their price targets, and management just openly admitted they are navigating a severe, an existential liquidity crisis.
Which forced a management change and a complete strategic U-turn. We'll get into that.
Yeah.
So our deep dive mission today is intensely focused. We have to use the sources, the cold, hard numbers from this past quarter to figure out if PLE is finally pivoting towards sustainable execution.
Or if this remains the ultimate story stock that is, structurally running on fumes, regardless of how big those market tailwinds are.
To tackle this intensely binary situation, we've structured our deep dive into 7 critical chapters.
Building the case layer by layer: business, management, financial, sentiment, ownership, risk, and then our conclusion. Our goal is to use math to challenge that grand vision.
Part 1. Chapters 1 to 3. Business, Management, and Financials. Chapter 1. Business Understanding.
Okay.
Let's start with the vision, because it's where all the billions of dollars of speculation really originate.
Right. Plug Power's pitch isn't just to sell a few components. It's this highly ambitious strategy to be the world's first end-to-end green hydrogen ecosystem provider.
They wanted to own the entire process.
The entire thing, from the creation of the fuel all the way to the maintenance of the vehicles using it.
This is their one-stop shop pitch. And while it sounds elegant on a slide deck,
the operational complexity is just staggering. I mean, it essentially decided to be 4 capital-intensive businesses at the same time.
4 businesses. Okay, break that down.
So 1, a manufacturer of fuel cells and electrolyzers. 2, a chemical processor focused on hydrogen liquefaction. 3, a national logistics and fueling company. And 4, a global field service provider.
All under one roof. And we see that reflected in their revenue streams. They're incredibly diverse, but also, I imagine, incredibly difficult to manage.
That's right. The first stream is the core sales of equipment. This covers their legacy GenDrive fuel cells and their big growth product, the Geneco PEM electrolyzers.
Okay.
Second, you've got recurring revenue from services. These are long-term service agreements, or LTSAs. Third, there's revenue from leasing, often called power purchase agreements.
And the last one.
The most vertically integrated part: fuel delivery, or Gen Fuel. That's the actual sale of liquid hydrogen and the fueling stations to their customers.
That model just screams operational exhaustion and capital strain.
But before we get to the financials, let's talk about their 2 distinct markets. The first one is what gives them credibility.
Right, the legacy market. This is their undisputed base. The GenDrive fuel cell systems used in material handling. We're talking forklifts, distribution centers.
And they are the leader here.
Undisputed. They've deployed over 72,000 units globally. Their key pedestal customers are giants: Amazon, Walmart, Home Depot. That installed base is a massive historical asset.
But the valuation, the reason we're even talking about this is not based on forklifts. Not at all. The growth story, the multi-billion-dollar bull case, rests entirely on the Geneco business, the production of green hydrogen itself.
The proton exchange membrane, or PEM, electrolyzers.
Exactly. These machines use renewable electricity to split water into green hydrogen, and Plug Power is playing at a global scale here.
Their gigafactory has, what, a capacity of 2,500 megawatts?
Yeah, that's an annual capacity that rivals established players like China's LONGi and the US-based Bloom Energy, so they've scaled the manufacturing side.
And this is translating into real-world projects that the bulls are always citing.
Yes, absolutely. They have a massive 100-megawatt deployment at Galp-Sines refinery in Portugal. That's one of Europe's largest.
And they just announced a new contract in the UK.
A 55-megawatt contract covering 3 separate projects. So these are real.
And those real projects validate the value proposition. This integrated ecosystem creates high switching costs.
It creates a sticky customer base. If you're a massive corporation and Plug handles the entire hydrogen loop for you, from the cell to the fuel to the maintenance, well, moving away is financially and logistically debilitating.
That's the potential moat they spent 25 years trying to dig.
But digging that moat came with enormous operational risk. You just can't master 4 different industries, manufacturing, chemical processing, logistics, and global service, without massive capital and extreme competence across all of them.
And that's exactly where the wheels came off.
Precisely. The attempt to master everything stretched their capital and execution capabilities incredibly thin. It's why they constantly needed new funding.
So this operational complexity, trying to do too much too soon, that's the root cause of the financial underperformance.
It's the singular root cause. The business model is a visionary idea, but it has proven fundamentally unworkable under the weight of its own ambition.
Okay, let's look at the broader industry. That projected market growth, $388 billion by 2035, that's the only thing keeping this stock alive.
That enormous total addressable market, or TAM, is the foundation of the bull case, no question. But that TAM is being fought over fiercely. Plug is engaged in a brutal two-front war.
Okay, what's the first front?
The pure-play peers. Companies like Nel RSA, Ballard Power, and most importantly, Bloom Energy.
And Bloom is a great comparison.
It is. Bloom Energy's stock is up 95% in the past year. Plug is down almost 50%. And why?
Margins.
Margins. Bloom focused on generating better margins, not on this capital-heavy vertical integration. The market is rewarding immediate profitability, even modest profitability, over some grand vision.
And the second front, this one feels more dangerous.
This is the existential threat, the industrial giants.
Cummins, Siemens Energy, Linde.
Right. They have massive, diversified balance sheets, decades of global manufacturing expertise, existing customer relationships, and, most crucially,
Profitable core businesses to fund the R&D.
Exactly. They can fund hydrogen research indefinitely. Plug Power simply does not have the luxury of time or cash to compete on this front.
And the entire sector's viability depends so heavily on government backing, this regulatory dependency.
It's a huge factor. Subsidies, specifically from the U.S. Inflation Reduction Act, are essential for making green hydrogen competitive with cheaper, carbon-intensive fuels.
And that dependency is a sword of Damocles hanging over them.
We saw it. We saw the severe immediate risk when Plug Power was forced to suddenly suspend activities related to a planned $1.666 billion DOE loan guarantee.
A $1.66 billion loan. That was supposed to be the cornerstone of their domestic build-out.
It was everything. And the sources say the suspension was due to perceived shifts in clean energy funding policies.
Unpack that. What's the real consequence of losing a loan guarantee of that size?
It's a colossal instant blow to your capital planning. It signaled that management could no longer rely on subsidized, cheap government capital to fund their expansion.
So they were forced back into the expensive and dilutive private markets.
Instantly, just to survive. It shows how quickly an external regulatory interpretation can become an internal liquidity crisis. The government basically said, we might not fund your capital-heavy model. And that sent management scrambling.
Let's transition now to the core competitive flaw.
Yeah.
The issue that really overrides all the potential in that TAM, the gross margin problem.
This is the fundamental, non-negotiable math problem. The 5-year average gross margin is a catastrophic negative 66.8%.
And it's getting worse. The trailing 12-month, or TTM, gross margin is negative 70.7%.
Yeah.
Let's make sure everyone really grasps the gravity of that number. What does a negative 70.7% gross margin mean in the real world?
It means that every time Plug Power produces a fuel cell, a fueling station, or delivers hydrogen, they are losing money on the transaction itself.
Before any other cost.
Before anything else. For every dollar of product they sell, the direct costs of making that product, raw materials, factory power, direct labor, are $1.70. They are losing 70 cents per dollar of revenue.
It's like a clearance sale that never ends.
It's worse. They are fundamentally paying customers to use their products. This isn't a slight disadvantage, it is a systemic failure of their product pricing and cost structure.
So every new customer, every new contract, every dollar of revenue actually makes them burn cash faster.
It accelerates the cash burn. This is a math that must be reversed for the company to survive. Period.
Chapter 2, Management Evaluation.
Right.
Given those catastrophic unit economics we just discussed, and the liquidity crisis that followed the DOE loan suspension, the focus has to shift entirely to leadership. And we saw a massive change in October 2025.
It was a seismic shift. Andy Marsh, the CEO who had been there since 2008, the architect of this whole 17-year end-to-end vision.
He's out,
Right.
replaced by Jose Luis Crespo.
Effective upon the 10K filing. So Marsh, the visionary who built the dream, but also oversaw 17 years of continuous financial losses and share dilution.
He's finally gone.
And in comes Crespo, who rose through global sales. His background is execution, operations, bringing business divisions together. The message from the board is crystal clear.
Patience with building the dream ran out. The priority has shifted from ambitious growth to basic survival.
100%. And Crespo's team was immediately thrown into an acute crisis management situation, specifically that liquidity crisis triggered by the Q3 cash burn.
What were the numbers that forced this sudden pivot?
It's the end of Q3 2025. The company had a critically low cash balance of only about $166 million.
And they were burning how much a quarter?
About $90 million in operating cash every single quarter. So they were facing imminent insolvency within 6 months if they didn't act decisively.
That is terrifyingly thin.
Mm.
So on November 10th, 2025, they announced the pivot for survival. What did that lifeline plan entail?
First, they formally suspended the $1.66 billion DOE loan activities. Second, significant operational cuts across the board. And third, most critically, they announced a plan to generate $275 million in liquidity through asset monetization.
Okay, let's detail that asset monetization. This wasn't capital raised by selling new shares or new debt.
No, this is emergency funding. Asset monetization means they are selling future cash flows or non-core assets.
Like selling the rights to future electricity generated by a plant.
Exactly. Or selling long-term maintenance payment streams to a third party, likely at a steep discount, in exchange for immediate cash. This is purely survival capital.
It's a bridge loan to get them stable. And it signals a major capital allocation reversal. The old way was disastrous. Growth at all costs, funded by continuous share dilution.
Yes. And the new strategy is a complete reversal toward asset-light operations. Stopping heavy capex with the DOE suspension is one part.
What's the other?
The other part is this stunning reversal of their own vertical integration model. They announced a new supply agreement with a major third-party industrial gas leader.
Wait, so Plug will now buy liquid hydrogen?
In certain areas, yes, to reduce their own near-term capital expenditure burden.
So after 17 years building this vertical moat, losing 70 cents on every dollar to maintain it, they're now unintegrating themselves to save cash.
That's it.
Doesn't that fundamentally compromise the whole sticky customer base idea?
It absolutely compromises the long-term strategic advantage. They're essentially renting pieces of their supply chain from competitors. They're prioritizing near-term financial survival over long-term market dominance.
And they try to couple this painful retreat with a strong new narrative, pivoting hard to markets popular with investors right now.
Yes, the AI data center pivot. They are now pitching their fuel cell systems as critical, reliable backup power solutions for AI data centers.
To generate quick cash.
Right. And to tie themselves directly to the AI boom, which is a powerful message for the retail investors who heavily influence this stock. The hope is this market offers faster sales cycles and potentially better margins.
Okay, let's talk about the hard metrics, the historical evidence of value destruction.
This is the unequivocal proof. The trailing 12-month return on invested capital, or ROIC, is a disastrous negative 19%.
A negative 19% ROIC is a death sentence for a business model. It means they are just inefficiently burning capital.
It means that for every dollar of capital, debt, and equity that management invested in this company over the past year, they destroyed 19 cents of value. The decades-long business model has been an efficient incinerator of shareholder capital.
And the return on equity.
Equally catastrophic at negative 93.85%.
Finally, we have to touch on transparency and credibility. They have a history here, including that 2024 going concern warning.
And while that warning was later removed, the underlying distress clearly remains. Management has a consistent pattern of issuing positive press, the big sales, the vision, while often masking the operational and financial misses.
Like in Q3.
Exactly, highlighting a slight EPS beat while glossing over a major revenue miss. It erodes trust, and it makes it very difficult to constantly raise money when your credibility is strained.
Chapter 3. Financial health.
The numbers.
If the business section laid out the complexity and the management section detailed the crisis, this section provides the cold, hard numbers that explain why the stock is trading at $2.
The current market cap, $1.75 billion, is a reflection of the market's severe concerns. It's down massively from its 52-week high of $458.
And for a supposed growth stock, the growth narrative is completely stalled.
That growth deceleration is a major flashing red light. Q3 2025 year-over-year revenue growth slowed to a pathetic 1.9%.
Unacceptable for a company that needs constant funding just to survive.
And management was forced to slash full-year 2025 revenue guidance down from that optimistic range of $850 to $950 million.
All the way down to $700 million.
Cutting guidance by over $200 million signals massive non-recoverable execution issues. That's what forced the board's hand.
Now we return to the core of the problem, the profitability crisis.
Yeah.
We have to re-emphasize these numbers.
Absolutely. The gross margin is negative 70.7% TTM. As we said, the cost of goods sold is $1.70 for every dollar of revenue. And when you add in R&D and SG&A...
The operating margins are just catastrophic. Negative 197% to negative 286%.
And management has set this incredibly optimistic, if not heroic, goal.
Gross margin break even by the end of 2025.
Moving from negative 70% to zero in 1 year, while also executing a massive strategic pivot. I mean, that's a challenge few major corporations have ever successfully pulled off.
It requires a fundamental restructuring.
In record time. And all this feeds directly into the massive cash flow and losses problem. Plug Power has never, ever generated positive free cash flow. It is a cash burn story. End of discussion.
In Q3 alone, they had a cash outflow of $90 million.
The number that threatened immediate insolvency. But the most staggering number might be the net loss for that single quarter. A colossal $361.8 million.
That quarterly loss is more than double the company's entire revenue for the same period. This isn't a company that's growing. It's a company subsidizing its entire existence.
Yeah, with borrowed and printed money.
Let's check the balance sheet. They hold about $677 million in debt. Debt to equity is 45%.
Which is dangerous, considering the perpetually negative operating income. They have no internal cash flow to service that debt.
And the current ratio, their ability to pay short-term bills.
It's a thin 1.32. While technically solvent, that cushion is way too thin when facing an immediate cash crunch. A huge chunk of those assets, between $555 and $682 million, is non-liquid inventory.
Which confirms the life-or-death urgency behind that $275 million liquidity plan.
Exactly.
Finally, valuation. Since they have negative earnings, we have to use the price-to-sales ratio of about 4.6.
And this is the classic PS trap. The bulls look at that and say it's cheap for a 45% growth market. But the disciplined investor has to ask, what are you buying sales of?
You're buying sales that come with a guaranteed negative 70.7% gross margin.
Exactly. You're paying a high multiple for revenue that guarantees a loss. It's fundamentally illogical and, frankly, insanely expensive. You're not buying revenue, you're buying a promise.
A speculation that management can perform a miracle.
Right. And if we try an intrinsic valuation using a discounted cash flow model, well, you see why fundamental valuation is impossible.
It's financial science fiction.
It is. Since they have no positive free cash flow history, any DCF is purely based on guessing when the profitability miracle happens. That leads to a massive contradictory valuation range.
From a speculative high of $7.31
to a frightening negative intrinsic value of negative $2.13. This confirms the stock is a binary all-or-nothing bet.
That brings us to the end of part 1. We have thoroughly established the fundamental math problem facing Plug Power.
If you appreciate the intensity and depth of objective analysis required to cut through the narrative on complex stocks like this, remember that we have a full library available for our members.
For $4.99 9-month, you get access to over 500 deep dive videos on all S&P 500 stocks, with the NASDAQ 100 coming next, plus members-only requested deep dives. It's the ultimate shortcut to being thoroughly well-informed. Part 2. Chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion. Chapter 4. Market sentiment. If the fundamentals are disastrous, the stock price's multi-billion-dollar valuation must be driven by something else. And that something is sentiment and technical factors.
The analyst community, for its part, is reflecting that uncertainty. The consensus rating is neutral or hold.
And their average 12-month target of $2.88 is only marginally above the current price.
But the range is what tells the real story. It confirms the binary nature of the stock. Targets run from a high of $7 to a low of 75 cents.
That massive divergence means analysts either believe the turnaround will succeed spectacularly,
Or it will fail completely. There is no middle ground.
and the most recent action was bearish.
Yeah, Susquehanna downgraded the stock, cutting its target from 350 to 250, citing persistent uncertainty. That news immediately contributed to the stock slide, indicating professional conviction is pretty low.
Technically, the charts confirm a dominant bearish long-term trend.
No question. The stock is trading definitively below both its 50-day moving average and its 200-day moving average. The momentum is clearly to the downside.
Which brings us to the factor that makes this stock incredibly explosive: the short squeeze fuel.
This is critical. Short interest is exceptionally high, sitting at 23.73% of the float.
That is massive. We're talking about 310.6 million shares held short by investors betting the price will fall.
This is a powerful, active, bearish signal from sophisticated institutional money. It indicates deep skepticism about the company's ability to fix its unit economics.
But
It is also a highly sensitive coiled spring. If the new CEO, Crespo, manages to deliver any unexpected positive news like even a slightly positive gross margin, all 310 million of those shares must be bought back immediately.
which would trigger a massive parabolic short squeeze.
Exactly. This extreme short interest is what makes the stock a high-risk gamble driven by technical hope, not fundamental valuation.
Chapter 5. Ownership structure.
Mm-hmm.
This is where we learn who holds the cards and who benefits most from this volatility. Let's look at institutional holdings first.
Institutional ownership is relatively low for a company of this profile, sitting at about 37 to 38%. The largest holders are the Vanguard Group and BlackRock.
And we have to emphasize, this does not signal conviction here.
Not at all. Vanguard and BlackRock are primarily passive index trackers. They own Plug Power because it's a required part of various indices like the Russell 2000. This is passive ownership.
They won't actively vote against management or demand strategic change.
Right. They reinforce the status quo despite the horrific financials.
Now, for the value investor's most alarming red flag, insider holdings. How much skin in the game do the executives actually have?
Very little. Insider ownership is tiny at just 2.44%.
Wow.
In a turnaround situation where management is asking shareholders to fund a capital-intensive recovery, this tiny percentage suggests a severe lack of alignment.
They have very little of their own personal wealth tied up in the company's success.
And there's a notable absence of significant, confidence-inspiring open market buys following this recent crisis.
So if institutions are passive and insiders aren't buying, who is the key driver? Who owns the majority of this company?
The largest single shareholder group is retail investors. They own a commanding 56% of the company.
That single fact synthesizes everything.
It explains it all. It explains why the stock sustains a multi-billion-dollar valuation despite those horrific financials. Plug Power is the quintessential story stock.
Driven by individual investor sentiment, the hype about green hydrogen, and that massive short squeeze potential.
It is a true battleground stock, where the fundamentals take a definitive backseat to the macro story.
Chapter 6. Risk assessment.
Okay.
Let's formally walk through the risks and opportunities using a SWOT analysis. Let's start with the internal strengths.
The strengths are their innovative PM technology, their pioneer status, that massive deployed fleet of over 72,000 units, and the potential for a sticky customer base from their ecosystem model.
Now, for the overwhelming internal weaknesses, the reality that has driven the stock down nearly 50% this year.
The weaknesses just dominate the analysis. Number one is the systemic failure of the negative 70.7% gross margin. Then you have severe perpetual cash burn, a 25-year history of accelerating losses, and recent execution failures.
Like the massive slashing of 2025 revenue guidance.
Exactly. They failed to execute on the vision.
But there are massive external opportunities that keep the dream alive.
The primary opportunity is still that enormous $388 billion TAM growing at 45% annually.
And the big global contracts show they can still win business.
Right. And the new narrative tie-in to AI data centers could generate quick, necessary cash flow. Plus, that internal Project Quantum Leap cost-cut initiative to find $200 million in savings, that's a crucial opportunity.
And the threats. Externally, they face intense competition. But let's focus on the two critical macroeconomic threats because they are actively making the new CEO's job so much harder.
First, high interest rates. The era of free money is over. For a company that must continuously raise capital to cover its cash burn, high rates make new funding significantly more expensive.
More expensive debt and more shareholder dilution from issuing stock at low prices.
Yes. And inflation directly attacks their core weakness, that negative gross margin.
How so?
While inflation creates continuous upward pressure on raw materials, steel, platinum, and labor, this increases their cost of goods sold.
So it puts even more downward pressure on the negative 70% margin, making the path to break even longer and more difficult.
Precisely.
But perhaps the most direct external risk is the geopolitical threat from the U.S.-imposed tariffs of 2025.
This is a direct hit to the business model. New tariffs on critical materials like steel, aluminum, and Chinese-made inverters will immediately increase costs.
Their business requires massive capex for new plants and high cost of goods for their components. So these tariffs hit both sides.
They hit both sides. They increase the capital costs of building new infrastructure and the ongoing cost of making the products they sell.
So the company is trying to climb out of this 70% negative margin hole.
And external policy is actively dropping more heavyweights into that hole.
It makes the job almost impossible.
It guarantees that the monumental task of margin repair just became even harder, severely reducing the new CEO's window for success.
Chapter 7, Conclusion.
Arr.
This is where we synthesize the narrative of massive potential against the reality of broken math. Let's start with the summary of the bull case. The speculation.
The bull case rests entirely on three speculative pillars. First, the massive market, the sheer size of the TAM. Second, the decisive management pivot.
The hope that the new CEO, Crespo, and the focus on AI and cost cuts will finally impose financial discipline.
And third, that powerful technical setup, the conviction that the 23% short interest creates a high probability for a massive short squeeze.
Now for the overwhelming counterargument, the bear case. The math.
The bear case is grounded in arithmetic. The business math is fundamentally broken, shown by that negative 70.7% gross margin. This is a company with a 25-year history of accelerating losses, not shrinking them.
It just navigated an acute liquidity crisis, requiring a desperate $275 million lifeline.
And critically, the competitive macro and geopolitical headwinds, tariffs, high rates, profitable competitors are all actively working against the company's ability to pull off this turnaround.
And the valuation verdict, based on our DCF analysis, was the ultimate statement of uncertainty.
Yeah, it confirmed that traditional valuation is financial science fiction. The massive range from a speculative high of over $7 to a negative intrinsic value. It just confirms this is a binary boom-or-bust proposition.
It's based entirely on future hope, not current financial reality.
Exactly.
So what's the concluding outlook for the investor looking at this stock at $2.09?
At $2.09, Plug Power is priced not as an investment with a margin of safety, but as a high-risk option. For a disciplined value investor, the business is too hard. It has no cost advantage, the unit economics are fatally flawed.
And it has a long history of destroying capital,
Yeah.
proven by its abysmal negative 19% return on invested capital.
Yes.
Therefore, the stock is purely a speculation on management performing a financial miracle.
It is a speculation on whether a difficult and highly uncertain strategic turnaround can succeed, meaning fixing that negative 70% margin before the company runs out of cash again. Given the scale of the financial hole and the headwinds, that is a huge mountain to climb.
And that leads to our final provocative thought for you to chew on. Consider the sheer magnitude of this problem. Plug Power just recorded a quarterly net loss of over $361 million, which is double its revenue, and its gross margin is negative 70%. The task of reversing a negative 70% gross margin is unprecedented. The question isn't whether the green hydrogen market is big enough. It is. Can the new CEO's pivot to the AI data center narrative provide enough profitable cash flow to buy him the time he desperately needs to fix the broken internal math? Or will the historical value destruction continue until the inevitable?
This analysis was generated by an AI research system for educational purposes and should not be considered financial advice. Please conduct your own extensive research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. The decision is yours. But now you have the numbers and the deep analysis. If you've found this deep dive into Plug Power valuable, make sure to hit that like button and subscribe to Stock Analytics AI.